Welcome to the Chart Traders Educational Course Part 1. This video will introduce you to the basics of Forex trading. In order to start understanding how the Forex trading works, we will be explaining the most important terms that you will need to know and will be using on a daily basis when trading with Forex. First, let's see. What does Forex stand for? Forex, or foreign exchange trading, is the activity where you can expect if one currency will get stronger or weaker relative to another currency. For example, right at this moment, with one Australian dollar, we can buy 0.66 US dollars. This exchange rate can be changed at any time. Changes in prices happen from the big banks, which are continuously adjusting to the rhythms of supply and demand that are responsible for this exchange fluctuation. Let's make an example of a price movement expecting that the Australian dollar will become stronger than the US dollar. In this case, we buy the Australian US dollar pair. And if we expect that the Australian dollar will get weaker, then we sell the Australian US dollar pair. An example, at the ATM with one Australian dollar, I can buy 0.6600 US dollar. If I buy the Australian US dollar pair, then I'm expecting Australian dollar will go up against the US dollar. Now let's expect that the price has risen by 7 cents. That will mean that my trade has won 6.60 US dollars. To figure out how much we just made, first we need to check how many Australian dollars we traded with. Let's say for this trade, we risked 10,000 Australian dollars before placing my trade. In the example above, 10,000 Australian dollars would have brought me 6,600 US dollars. But after my trade was finalized, 10,000 Australian dollars would have bought me 6,607 US dollars. In this quick trade, we made 7 pips against the US dollars. What is pips? 1 pip represents 1% of 100%, or 0.0001, which is the smallest amount of currency fluctuation used in Forex, and it's the unit used to express the price change of an exchange rate. To understand how leverage works, let's assume that you believe that the euro will become much stronger against the US dollar. And you are very confident about this. And you would open up a trade with 100,000 euro dollars, but you can't offer it here. The broker will let you take the risk, and he will lend you the 100,000 euro dollars. All they need from you is only 1,000 euro as the collateral deposit. From the brokerage firms, you can borrow up to 500 times the amount of your initial collateral deposit. An example, if you risk $1,000 from your own money, then you can place a trade between 1,000 to 500,000. It's up to you. Things to know: 1,000 equals micro lot, 10,000 equals mini lot, 100,000 equals standard lot. Thank you so much for tuning in. Hope this lesson has been educational and very informative. Please let us know in the comments any feedback or anything that we can work on to make sure that your experience and your lessons are well met.